Good afternoon, everybody. My name is Greg Williams. Along with me today will be Greg Dickerson. He's a senior director. Well, I'm a senior director. Greg is the director in reinsurance. And today we're going to cover some high-level trends that we're seeing within the industry. So the path forward is pretty straightforward. I'm going to talk a little bit about the market segment outlooks that we have on the various segments and lines within the US PC industry. Then I'm going to turn over, take a look at property casualty financial results, both from a high level from overall, but then break that down by the commercial and personal line segments. And then I'm going to turn it over to Greg, who's going to take a deeper dive into the global reinsurance industry. It's very timely given the APCIA conference, given the upcoming renewal season. So Greg's going to take a deep dive into the global reinsurance industry. And then finally, we'll open it up for Q&A. I don't expect our presentation to take the full hour. So from a logistical standpoint, we're going to go through the presentation, go through the materials, and then at the end, open it up for Q&A. And then we'll get to any questions that you guys have. Sound good? Okay. So market segment outlooks. So let's talk a little bit about what they are, what they represent, and how they differ from outlooks on rated insurance companies. So what we try to do here with the market segment outlook, we try to capture what events are impacting the companies that operate within a certain segment and how that will transpire over the next 12 months or so. So some of the factors that we consider in the market segment outlooks are the current and forecasted economic conditions, the regulatory environment in which the companies operate, any line of business developments that we see, either from rates, terms and conditions, adverse loss reserve development, and then how the competitive landscape is shaping up within that segment. The outlooks can be positive, negative, or stable. We're going to go through some of the outlooks, and you're going to see there's a variety of outlooks that we have on these segments at this point. But importantly, market segment outlooks are not directly connected to rating outlooks. So for example, personal lines market segment outlook is negative. That doesn't mean that all the companies within personal lines have a negative outlook. What it means is that the conditions impacting those companies are negative in nature, but there are going to be companies within that segment that might be able to address those issues in a positive way and separate themselves and show their competitive advantages. So there's a possibility, and we have seen it, where you have a positive outlook on specific companies with a high rating within an overall segment that has a negative outlook. So it's a key distinction, and I think it sets us up nicely to discuss going forward. All right, so why don't we start off with personal lines. So there's been a lot of news around personal lines companies, large ones, small ones, mid-sized ones. There's been a lot of negative connotations going on within the personal lines industry, and there's good reason for it. So in September of 2022, we went negative on the personal lines segment for the first time that I can remember. I've been here now for about 17 years. I think that was the first time that we had a negative outlook on the personal lines industry. At the same time, we also took a negative outlook on the personal auto lines of business. Again, that's driving the overall personal lines outlook. Fast forward 12 months, in September of 2023, we went negative on the other line of business, main line of business, and that's homeowners. Again, seeing some of the pressure really translating into deteriorating operating results. So again, we're negative pretty much throughout the personal lines industry, reflective of those results. And underlying those results is rising loss cost severity. So we see it in a number of different facets, in a number of different areas. We see it in higher fatalities. We see it in the cost to repair new vehicles. We see the labor market shortage. We see parts. We see higher used vehicles. We see social inflation combined with general inflationary trends. So all that is really impacting the loss cost severity that we're seeing in the personal lines market. And then on top of that, companies are trying to take rate. And it's been challenging. It's been challenging. I think personal lines, we know, started taking more accelerated rate back in 2021, 2022, more rate, 2023, more rate, and they just can't seem to catch up. And there's a number of reasons for that. On the homeowner side, obviously, with the 12-month policies, There's state restrictions, and thankfully those have eased recently somewhat. We have seen in talking to companies, personal line companies, we have seen at least some are moving towards, if not at rate adequacy for a number of states. It's not for all states. Companies are still pushing through rate, but I think they're encouraged over the last, at least in the last couple of meetings I've been, they're getting the rate that they think that will either get them to rate adequacy or close to it. Now that's going to take some time to flow in, so we don't expect over the next 12 months the personal lines market is going to rectify itself. It's going to take some time, so that's why we have the negative outlook there. Now, at the same point where we have the pressure on loss cost severity, we're seeing it on reinsurance costs. Everyone knows what the reinsurance market was last year. Really choppy, really hard to, it really disorganized as companies continued to try to get reinsurance terms. But what resulted was elevated reinsurance costs. There's tightened terms and conditions. And what we've noticed and what we've continued to see is higher overall retentions, I'd say, especially for maybe smaller companies in the Midwest. We've definitely seen incremental increases in the net retention. We've also seen co-participation in property lines. And that's important. So not only do you have the loss cost severity pressures, then you have higher net retentions that don't make it to the reinsurance market that companies take on themselves. And at a time where we're seeing heightened catastrophic activity, severe convective storms. It's not the named storms at this point that are really driving the results in 2023. It's the severe convective storms. I think I saw a study, there was $60 billion of loss, severe convective storm. First time was over $50 billion. So we're seeing that play out as well. And again, I mentioned the aggressive push for rate adequacy. We've definitely seen that. And companies we've talked to, they're raising rates every renewal they can. So every 6 months they're raising rates. But again, they're trying to keep up with these loss costs and trying to catch up maybe in some circumstances where they were behind the curve. With all that being said, I know it sounds like a horrid condition, but overall solid risk-adjusted capitalization still is in the market. That doesn't mean all companies in the personal line segments haven't seen or continue to have solid risk-adjusted capitalization. And we'll go through some of the rating upgrades and downgrades over the first half of this year. But for the most part, generally, personal line segment continues to have pretty strong risk-adjusted capitalization. Okay, so on the commercial line, it's a vastly different story. So it's almost a tale of two cities right here, because personal lines, you have all the issues we talked about. Commercial lines, outlook remains stable. So we've been stable on them for a couple of years now. And though it's probably past its peak in terms of pricing, we still see pricing momentum somewhere in the mid-single digits to upper single digits in most lines. Some exceptions to that, property a little bit higher, workers' comp obviously not to be seen. But we have seen positive rate pricing momentum there. That's leading to sustained strong underwriting performance that we've seen. We're going to show some results from the commercial line segment where we continue to see underwriting profitability. And again, this segment also going forward should start to benefit from the higher reinvestment rates, whereas maybe on the personal line side, more shorter term on the casualty lines and the commercial, we should start to benefit from the higher reinvestment rates as well. With that being said, there are loss cost severity pressures, just like there are on personal auto. These tend to be more on the commercial side around social inflation. So we can talk a little bit about that as we go into some of the financial results. And then there's always going to be the potential for large-scale CAT events for the property lines. That continues to be an issue that we continue to have conversations with commercial lines about. Continued vigilance on emerging classes of potential litigation. Again, something we're keeping an eye on as some of these longer-tailed casualty lines might be exposed to, whether it be dietary supplements, herbicides, pesticides. So those are the type of things that we're watching from a commercial lines perspective. All right, so not only do we do outlooks on the overall commercial lines, personal lines. We also drilled down a little bit on some key sectors within the commercial line sector. So just a few comments on this. What you will see is excess and surplus lines is positive. That's a new development that we just changed, I think today the publication went out. We did move from stable to positive on the E&S market. We do think the market has legs. What we've seen is, again, as admitted companies maybe put some into the E&S market, whether it be cyber, whether it be D&O, whether it be property. We're still seeing the submission flow. We're still seeing great results in the E&S arena, and we do think that has legs. So we did, if you haven't read, we did put the briefing out, so if you want to get more detail around our rationale around the E&S market, it should be available on our website today. Just a couple other things. Again, there's favorable pricing in both property and casualty lines. We continue to see, I mentioned workers' comp being the lone exception to that, but again, continues to have good results in the workers' comp, has really led the way in terms of combined ratio performance throughout the last several years. A couple other notes here is commercial auto. We thought we turned the corner. It looked like commercial auto turned the corner back in 2020, 2021. It was not to be. It does seem that it was more about reduced driving that was driving frequency lower. If you take a look at 2022 results and into 2023, again, there's no fundamental changes in the overall performance of commercial auto. In addition, I think there was $2 billion of adverse development in commercial auto line, half of it from accident year 18 and 19. So we still have some, commercial auto is a gift that keeps on giving. So we would expect that to continue here. In terms of, again, I talked a little bit about the sharply higher fixed income reinvestment rates. Again, we should see some benefit going forward. And then social inflation, again, continues to be the main concern on the long-term casualty lines. This is a new outlook. So when we presented last year, we had not put out this outlook. It's the Global Delegated Underwriting Authority Outlook. And it was first assigned in December of last year, and it was given a positive outlook. And again, so as we think about the distribution within the commercial lines, and we continue to see the commercial lines premium increase, a lot of that business is coming through these delegated underwriting authority enterprises. And I'm going to show slides shortly here to show you what level of premium we're talking about. But it is that specialty commercial business that is being helped by the DUAE market. So again, as we thought about the delegated underwriting authority market, we as an organization have paid a lot of attention to this market over the last several years. We put a number of briefings out. Last year, we engaged the market with the performance assessment for delegated underwriting authority enterprises. We'll go through that shortly here. And again, it's in recognition of what we're seeing within the insurance landscape. And what we've seen with the DUAE market is that the growth is being driven by a number of areas: technology, talent, and diverse sources of capital. Just want to focus a little bit on talent for a little bit. What we've seen is, as we talk to participants in the market, whether they be fronters, whether they be DUAEs themselves, or insurance companies that work with DUAEs, everybody's noted the same thing. A lot of the talent is coming from primary insurance companies, whether it be from a management role down to the underwriters or even claims. Technology as well. A lot of the technology resources that may have been with insurance primary carrier are now moving in some fashion to the DUAE. So again, that's professionalizing the market, we think, and again, that we expect that to continue. Again, the DUAEs, the MGAs, and I'll use that interchangeably, DUAE and MGA, but the ability to address underserved and emerging risk continues, again, specialty commercial area. Profit sharing structures have grown notably, reinforcing contractual alignment of interest. One of the bigger things, I mentioned the talent, I would say this is probably the other area that really has professionalized maybe the market. Not to say that there aren't bad actors, there are, we've seen that, but we do think that the profit sharing really aligns the MGA with the insurance company and then eventually to the reinsurer as well. Now we have seen continued strong interest in the fronting market. MGAs use fronters to get capacity. Fronters use MGAs to get business, and that alignment is still there. Now, there have been notable incidents in the market, obviously Festu being one of them. We're continuing to see how that plays out in terms of, does this cause any concern from a reputational standpoint to work through this relationship? At this point, we haven't seen that. We still see, as you guys know, there's over, I think, 20 fronters at this point, and we really haven't seen any downturn within the fronting market. We haven't seen a downturn in fronting fees. So again, we do think there's enough business in the market at this point. There's been a lot of talk about consolidation within the fronters. We haven't seen that yet. There has been some moves, but that's really more of different sponsors or different financial owners of the company than a true consolidation. So it's something that we're keeping an eye on and something that will impact the market going forward. But at this point, still see continued strong interest in the fronting market. One of the other concerns when we put out the outlook in December of last year was elevated reinsurance costs and capacity constraints in pockets of the market. So as we were putting out the outlook for the DUAE, we did have conversations with companies, and there was a constraint on capacity for property cat programs, and maybe to some extent to cyber. So we did have conversations. It's something that we considered in the outlook, but we didn't think that it would be a spread where there would be capacity crunches on other lines. So we went with the positive outlook, and over the last 10 months or so, we haven't seen that really spread to other lines of business. So we feel good where we put the positive outlook with the DUAE business. So I talked a little bit about what we're seeing within the DUAE market. This kind of just gives you the premiums that have gone through DUAs, and we get this from Note 19 and statutory statements. And again, this is understated by virtue of how they report basically, you don't have to report if the premium generated by the MGA is less than 5% of surplus. So again, this is very understated. It shows about $65 billion, and this is only U.S. of premium flowing through these DUAEs. You can see the growth rates pretty substantial, especially over the last 2 years, where you have double-digit growth within the DUAE sector. So again, just speaking to the continued growth that we're seeing in the sector as commercial specialty flows through these MGAs. I talked a little bit about the published performance assessments. Again, we went live with the methodology in February of 2022, and this kind of gives you an idea where we stand with the published performance assessments. There are private ones. We're also in conversations with other DUAEs as we move to release more public performance assessments. But this kind of gives you an idea. So the last one, AmWins, we just actually updated in November of 23. They got their initial assessment back in October of 22. Again, they're at the highest end of our performance scale at a PA1. But you can see there's a diverse number of companies here, diverse geographic locations. So if you think about Delta, the top two, or the second and third listed there, those are in the Singapore, Australia, New Zealand market. Corn is in the UK market. We have some US, First Indemnity, AmWins, and Excess Re. Excess Re is interesting. It's a stop-loss MGA out of New Jersey. So again, we're seeing value created through these performance assessments, and I think the DUAEs are seeing value created. Some of the conversations we've had with these organizations have talked about how capacity providers have reached out to them, saying that they got a performance assessment. And I know AmWins had success with Japanese regulators being able to maybe expedite some of their audits. So again, we do think it's valuable. We do think it's a competitive advantage for these companies that have gone through the rigor of the performance assessment, and we expect that to continue going forward. Okay, so that's from a market segment outlook. What I want to do here is just kind of concentrate on the financial results. And what we're seeing, this is on a property casualty basis, and just probably a few highlights of note. You can see really where the premium rate increases took hold back in 2021, where you're in the low single digits through that period, and saw about almost 10% in change in net premium written for the last few periods. The combined ratio, which it was profitable through 2021 on a combined basis, deteriorated in 2022 and thus far in 2023. You can see cat losses, which maybe average around 5 to 6 points, really have been heightened over the last several years. And again, the first half of 2023, we're looking almost about a 10-point cat loss ratio there. So some sobering numbers, I think, from a combined ratio perspective. And then you can see how that translates into some of the return measures at the bottom of the slide, gradually falling off, and after tax return on surplus of about 4% in 2022. I would say if you take a look at the combined ratio in 2022, part of that was while we still see favorable reserve development within the segment, and we have seen favorable on a total basis reserve development for about 17 years straight. That was about half of what it was in 2021. I think it was $7.2 billion in 2021. It's $3.6 billion in 2022. So we'll see how that plays out as well. So still favorable reserve development, albeit at about half of what it was in 2021. This just kind of breaks down personal lines and commercial lines, and I think it speaks to what we've already talked about with the commercial lines segment outlook and the personal lines segment outlook. We saw some rate activity beginning in 2021 with personal lines, and then heightened rate activity in 2022 and 2023. Combined ratio really pretty stark deterioration, starting at a 102.7, upwards of 109, and now 112 at the first half of 2023, and obviously the return on surplus follows suit. Commercial lines, different story. Solid combined ratios with pretty good premium increases. Now again, as I mentioned before, we're starting to see some of those rate increases taper off. Still getting rate increases, just not to the same extent that we have seen in the past. And again, this is on a net written premium basis, so not only does this take into account for rate, also exposure, so as companies grow in the growing economy, that's factored in there as well, along with insurance to value adjustments. So again, vastly different stories with personal lines and commercial lines. Okay, and then this is the last slide I have, and it really talks about what these results have meant in terms of ratings. And we've got a lot of questions around this. This comes out of a publication we put out pretty recently, I think, where it kind of goes through the rating activity that we've seen. So let's concentrate. Well, maybe let's start out by saying in 2022, this is all first half results. There was downgrades accounted for about 5% of overall rating decisions. In 2023, through the first half, what we've seen is that double to about 10%. Again, that's on all the ratings within this segment, personal lines and commercial lines. So definitely have seen an upgrade, an increase in the number of downgrades. So with that being said, let's take a look at the different segments. So personal lines. So in 2022, it was about same. You had about, let's see, 9 upgrades and 10 downgrades on the personal line segment in the first half of 2022. That's definitely a change. So if you take a look in 2022, or 2023, you had 8 upgrades on a personal line segment and 21 downgrades. Commercial lines, on the other hand, pretty balanced, 10 upgrades and 7 downgrades in 22, and about 13 upgrades and 10 downgrades in 2023. So really, this is a personal line story in terms of the rating activity that we've seen. So when you drill down on the overall rating activity, what building block is being downgraded? And what we saw is over a third of downgrades was on operating performance. So all the things that we talked about, the loss cost severity, rates not being able to keep up, the elevated net reinsurance retention, all that's playing into the operating performance downgrades that we've seen. So over a third was due to operating performance. When we take a look at the next bucket, balance sheet, Again, we talked about maybe the personal lines in total being solid from a risk-adjusted capital standpoint, but there are elements, there are companies within a personal line segment where that's not the case. So there was about, I think, 23% of the rating downgrades were due to balance sheet only. And then there's another bucket, which is balance sheet and some other bucket. So you have 23% balance sheet only, but then you have a couple, you have 23% that were had a double downgrade or more, meaning that not only was it balance sheet, but it was also another building block. So that could be balance sheet and business, balance sheet and operating performance, or it could be balance sheet, business profile, or ERM. So you can see at 46% of the downgrades included some element of balance sheet to it, and then operating performance, again, is what we're seeing. So I leave you with this, is that on the personal lines carriers now, there's, of the rating universe, there's about 20% with negative outlooks. So key over the next 12, 24, 36 months, because that's typically what an outlook runs, is improving the operating performance. And that's done through rates, it's done through underwriting, it's done through risk selection, aggregation management. So that would be key as we go through the next 12, 24 months, as we have 20% with negative outlooks in a personal lines arena, is companies being able to gradually, we know it's not going to happen overnight. We have conversations with the companies, what their projections are. We'll be marrying their projections to actuals over the next 12 to 24 months and try to determine, okay, is the company on the right path forward? And again, this will be a company-specific discussion and a company-specific decision as to the ultimate outcome of that rating. So that's kind of where we stand. What I'll do now is turn it over to Greg, who will give you a deeper dive into the global reinsurance industry.
Am I on here? Yes, great. All right, primary insurance, Greg. I'm reinsurance, Greg. Let's see everybody. All right, so yeah, we'll start the discussion around that market outlook for global reinsurance, the drivers behind it, and some of the key themes we've observed, and then I'll discuss some of the capital trends we've seen in the industry, as well as the market performance in recent years. So what are some of these key trends that we're seeing? Well, for starters, reinsurers are being very cautious with capital deployment. While we don't necessarily see a scarcity of available capital, we do see a shortage of deployed capacity, and I'll talk a little bit more about what we mean by that in a moment. And it's not just reinsurance management teams that are cautious about putting capital to work in certain areas. Investors are also viewing the industry with a skeptical eye, considering the industry's fairly unimpressive performance over the past several years. Another significant factor to consider is the increasing complexity of underlying insured risks, whether it's newly emerging risks that might include things like cyber exposure, or even the continuing evolution in the approach that reinsurers needs to take in assessing more traditional reinsurance exposures like nat cat risk, as Greg mentioned, the increasing prevalence of so-called secondary perils, including convective storms and wildfires as well. And it's particularly challenging to calibrate risk appetites on the underwriting side, while at the same time the industry is managing its way around some of the economic challenges and the capital market volatility that we've seen in the last couple of years. While all this is going on, you've got the rising interest rates and inflationary trends, not only driving loss costs up, as you'll all know, but also raising the reinsurer's own cost of capital. So we have this increasingly complex landscape and a demand for reinsurance protection to help mitigate the underlying uncertainty. At the same time, there's an understandable hesitancy of the reinsurance market to necessarily jump in and meet that demand. And the result is a protection gap that's bound to widen, and the need for reinsurers to find innovative solutions to either help close that gap or run the risk that someone outside the industry might find a way to provide those solutions. And if that were to happen, reinsurers could become less relevant over time. Don't see that necessarily as a near-term risk, but looking further down the road, possibly. That said, the reinsurance market has really proven to be quite resilient over its history. It's been adaptive and innovative in the past, so I think it's reasonable to expect that it'll continue to find innovative solutions going forward. So All that said, demand for reinsurance coverage remains quite robust and is very pronounced in certain areas, and that's a good thing for the market. And underwriting results and overall operating performance are getting better, driven by rate improvement as well as diversification of earnings, as companies that happen to be included in our global reinsurance composite have actually grown in areas outside of traditional reinsurance, including into casualty and specialty lines, which they often write on a primary basis. And then I'd also call out, similar to Greg, higher reinvestment rates on fixed income portfolios have driven significantly higher net investment income for most companies. So that's a nice tailwind that we expect to continue into 2024 as well. So the question, I guess, how long are these favorable reinsurance market conditions likely to last? So one of the key questions that we typically grapple with when we're thinking about, are we in a hard market, or how long is a hard market cycle likely to last, is what's the capital position? Is there a capital abundance or a capital shortage? And the answer presently is both sort of yes and no, whether there's adequate capital. And the important distinction to be made here is between available capital and deployed capacity. And there really isn't a shortage in available capital. And we think that's one of the key differentiating points between this hard market and previous hard market cycles. Reinsurers, for the most part, have sound capital management strategies and have really weathered the investment market turmoil fairly well in 2022 and 2023. We in the reinsurance market at AM Best haven't seen any balance sheet related downgrades in the reinsurance market. Where we've seen ratings pressure, it's more often been on operating performance. However, there certainly is a lack of deployed capacity, right, as people well know, most notably in the lower layers of property cat programs or cat exposed business in general. There's also a very limited appetite to provide aggregate covers. Over the past several years, many reinsurers have chosen to deploy more capital, as I mentioned, into the casualty and specialty lines, often writing this business on a primary basis to further diversify and reduce the volatility of their earnings. While many primary carriers now would love to purchase more reinsurance protection, especially in the so-called working layers of their cat reinsurance programs, fewer and fewer reinsurers are offering it now, right? Or at least at prices that might make economic sense to the primary companies. So at least for cat-exposed lines, safe to say we're in a hard market. But as I mentioned, the drivers of this hard market are a bit different from what we've seen in the past, so how so? For historical hard markets, what we generally see is a large loss event, or even maybe a handful of really big events that put a significant dent in the balance sheets of reinsurers. This would be followed by a steep increase in rates, which would in turn attract a new class of reinsurers backed by investors looking to take advantage of the strong pricing environment for as long as it lasted. But we really haven't seen a reinsurance class of 2022 or 2023. So why is that? Well, we think there are a few primary reasons, these aren't the only reasons, but maybe some of the primary ones. The first is that the higher interest rate environment is relatively new, and we don't think the market's completely adapted to it yet. Higher interest rates also bring a host of other attractive opportunities for potential investors outside of the reinsurance space. Another issue, as I mentioned, hasn't been one or more big events in each year driving results. It's often been a collection of medium-sized events and secondary perils which have now depressed results over a sustained period of time, just leading to a sense of loss fatigue for the industry and investors. And then the last point is the moderating impact of ILS, or the third-party capital markets. That market has helped maintain market capitalization at supportive levels, but it's no longer providing a cheap alternative to traditional capacity in the property cat or the cat retro markets. Great. So this slide is a visual representation of some of the things I just talked about. The blue line here is the rate on line index, and the red line represents interest rates. So you can see that there have been 3 periods of meaningful new reinsurance company formation: 92, 2001, 2005. All 3 periods followed major cat events, right? It was Hurricane Andrew in 92, 9/11 terror attacks in 2001, and KRW in 05. Each of these time frames saw a pronounced spike in rate on line and also interest rates. In more recent years, despite a number of years that included high cat activity, new capital hasn't flowed into the industry, as both rates on line and interest rates have remained persistently low. Quick glance, 2022, 2023 though, you can see that rates on line have finally improved to the point at which you'd think it could be attractive for new entrants. This is AM Best's measure of reinsurance market capital, which tells a similar story. Again, for the balance sheets, the capital measure doesn't include all the capital at their disposal. It's the capital that they've dedicated towards their reinsurance business. So you'll see in 2022, we've got a sharp decline in excess capital, which increases capital utilization in the market. And capital utilization is our measure of how much capital is required to maintain risk-adjusted capitalization at the strongest measure. As people will be aware, the 2022 capital decline, driven primarily by mark-to-market adjustments on fixed income investment portfolios, equity markets as well, most of which we would expect that to recover. However, the decline is also partially driven by the deployment of capital in the business lines other than property reinsurance or reinsurance in general, where the greatest demand currently resides. And this capital could take longer to find its way back into the traditional reinsurance market. ILS capacity, represented by the light blue position at the top of these bar charts, and has sort of plateaued for the last 5 years or so, following a multi-year period of very rapid expansion. In previous periods, ILS market's been blamed as one of the main culprits for soft market conditions, or at least suppressing greater rate improvement in the aftermath of big cat events. But now third party is viewed by the market less as a competitor and more as a resource to help reinsurers accomplish their goals. And this slide provides just the visual of the traditional reinsurance capacity shift away from reinsurance into primary lines over the past 5 years. This data comes from our reinsurance composite. The composite shows the 25 most relevant global reinsurance groups, many of which were originally set up as pure play reinsurers, but over time, in search of greater returns and the benefits of diversification, they've evolved to the point at which non-cat and primary business comprises a very substantial portion of their portfolios. So there's been a decline over this period from 75% to 62% in the allocation for reinsurance lines between 2018 and 2022. In addition to reducing premium writings, they're also moving higher up into cat towers and tightening terms and conditions for property reinsurance. Is this trend going to continue? Likely will depend on opportunities. We have recently noted an increasing tone of caution from global reinsurers surrounding U.S. liability lines, which have continued to be impacted by social inflation and now economic inflation as well. So maybe we see this mix start to shift back towards reinsurance over time, but it'll be interesting to follow. But through it all, reinsurers' financial positions remain very solid. There has been a decline in risk-adjusted capitalization scores, but not in our view of overall balance sheet strength. Companies still maintain sufficient capital to support their underwriting activities, and importantly, most companies maintain adequate liquidity to pay claims without having to sell their investments while they remain in an unrealized loss position. However, pressure on operating returns remains very prevalent. And then although we anticipate improved operating results, the cost of capital is also rising as interest rates rise. Which brings us to the main driver of the current hard reinsurance market, which is the market's realization that it really needs to demonstrate that it can improve its performance over a prolonged period of time and meet its cost of capital. And because this hard market's driven more by operating returns than a capital shortage, we think this hard market could persist longer than previous cycles, and some could argue that maybe it already has. So to put some numbers to this, the chart on the left side of this slide represents our global reinsurance composites return on equity over the past 5 years, which showing a not very impressive 5-year average of 4.6%. And then the chart on the right shows the median return on capital employed since 2010. That was represented by the red line, as well as the median weighted average cost of capital over the same time period, and that's represented by the blue line. And then the green line in that chart represents the economic spread between the return on capital and the cost of capital, revealing that only once in the last 6 years has the industry met its cost of capital, which at present is roughly twice the industry's 5-year average ROE of a little less than 5%. So while some years have been better than others, generally speaking, the results have not been enough to compensate for the risk assumed by reinsurers. And as I mentioned, right, not to repeat myself, it's led to loss fatigue among investors, and many companies and investors have pulled away from more volatile lines. This is another angle of looking at the same issue from the reinsurer's point of view. Slide on the left compares the 10-year combined ratio for our global reinsurance composite, represented by the gray line, compared to the performance of the primary commercial carriers, red line, and the primary personal lines carriers, represented by the blue line over the same time period. Chart on the right represents ROEs over the same time period. And these charts show that reinsurers have posted consistently worse underwriting results and lower overall profitability than their primary counterparts from 2017 to 2021. Still worse than the commercial guys in 2022, but the personal lines were so bad that the reinsurers finally beat them. Not very cheerful way of putting that, I guess. Yeah, but in general, the trends underscore the point that the reinsurers have absorbed a disproportionately high share of industry losses, really for several consecutive years and over a prolonged period. As you can see in this graph, right, this is combined ratios. Results have only recently begun to improve for the reinsurers, starting in 2021, continuing in 2022, 2023 shaping up to be very solid as well. But 01, 02, these were not benign cat years, right? So it wasn't just luck. Both had their fair share of major and secondary perils which impact returns, and that's been consistent with the trend of consistently high cat activity seen for the past 10 years, when the industry's averaged over $80 billion per year in cat losses. Several of the last 6 years have exceeded $100 billion in cat losses, and in 2022, global cat losses exceeded $120 billion. And that's what's driven reinsurers, or many reinsurers, to pull back property capacity or only offer high levels of coverage and instead focus more heavily on casualty and specialty lines just to reduce their underwriting volatility. And that is what's helped them improve their performance for the last couple of years. While many have scaled back, several leading carriers have remained in the property reinsurance market, taking advantage of the more favorable rates and terms and conditions. And this has sort of led to a bit of a flight to quality in the property cat reinsurance market. So that leads us back to the question of the insurability of certain risks and whether the resulting coverage gap could continue to widen. So for their part, in 2023, reinsurers structured their coverages to remove much of the lower layer cat coverages, and in some cases even to stay away from cat-prone areas altogether. As people will be aware, terms and conditions also tightened to reduce the impact of secondary perils, shifting much of the exposure for these perils away from the reinsurance market and back to the primary companies. So this shift leaves the primary carriers in a difficult spot, right? As they may not, in some cases, might not be able to any longer offer certain coverages without the reinsurance capacity as a backstop. So it remains a question then whether this lower layer aggregate and secondary perils coverage will eventually return to the reinsurance market in a meaningful way, and then how will primary carriers adapt if they don't? Will they curtail their own writings? Will they increase rates? And then what will the insureds do if certain necessary coverages become unavailable or unaffordable? Very complex issues, and it'll be interesting to see how that plays out as well. But for now, reinsurers have become much more diversified. The pure play reinsurer, and certainly the traditional cat-focused reinsurer, have become nearly obsolete, and we anticipate further diversions from that model in the years to come. As far as capital raises among established carriers, a few select diversified carriers have been able to raise capital to support business growth, although we typically see this capital raised to support all aspects of the group's business and not just reinsurance. The few new companies that have formed in recent years have also featured a more diversified model rather than the specialist route. And then quickly, what do we expect ahead? Over the next year, we expect underwriting results to remain strong. Some major players will continue to expand their reinsurance segment to capitalize on the hardening market conditions. We do not expect new entrants to enter the market in a very meaningful way, certainly in 2023. Maybe in 2024, but likely not on a scale that would really make a big difference. We have seen a number of proposed new projects come through our doors over the last 12 to 24 months. These companies typically had sound strategies and had well-regarded management teams with strong track records, and ultimately the project stalled because the capital just wasn't there in the end. As mentioned, right, this is primarily driven by continued economic pressures, more attractive opportunities outside the reinsurance space, and then loss and fatigue and just decreased appetite for volatility among investors. With the lack of new entrants, we do anticipate that the reinsurance terms and conditions will remain tight and rates are unlikely to come down meaningfully in the near term. And think that what would cause that to change, more a sustained period of improved profitability before the cycle would return turn in a meaningful way. So I'll just finish up with a recap of what I hope will be your key walking away points from my session. Not a capital shortage per se, but deployed capacity selectively constrained. Reinsurers' results are improving, but reinsurers are really still playing catch up in terms of demonstrating that they can consistently generate adequate returns. And then as business models continue to evolve, it seems like there's a clear preference among investors for a diversified multi-pronged strategy as opposed to the specialist. That, I think we left 10 minutes or so for Q&A. If anybody has any questions for either of the Gregs. Great.
That retention issue on the reinsurance by the primary carrier, is there a sign of something else happening after that, or is that just one step in the process with higher reinsurance costs? Or do you see that changing in the future, where companies will try to modify that? In our particular instance, we're into a capital raise and a retention issue both at the same time. So we're doing both as we speak today.
Yep. Craig, did you want to think about that from a primary perspective?
Yeah,
What do
you
you
want to
see?
address it from reinsurance? I'll start with primary, what we're seeing on the primary side. So, yeah, I think to your point that we've seen a lot of companies take a net higher retention. When we dealt with one company who had raised their net retention maybe $500,000 to up $500,000. In one half a year, took 7 hits on that, so $3.5 million. So there has been a higher net retention. What companies are doing about it? Yeah, I think they are taking a look at capital raising, whether maybe surplus notes or something to that effect. We have seen companies enter into that. I mean, what we expect to see also, maybe an increase in mergers, affiliations. We could see that happening. Book rolls, as companies realize, you know what, we don't have the capabilities. If it might be a small part of their book that's a lost leader, why are we even in this, given this reinsurance environment, given that the rates we aren't able to get the rates. So we do expect that to increase over the future. So I do think there's outcomes still to be determined because this isn't going away. I mean, severe convective storms isn't going away. It's just becoming just as problematic as the named storms. So companies, yeah, I think there's other avenues that they're pursuing that is outside of reinsurance.
Yeah, and then as far as reinsurance support's concerned, I think there are some reinsurers that would be selectively willing to partner, like on pro rata deals with strong performing primary carriers, but again, that'll be selective.
So do you see the MGAs or the DUAEs being supported by more traditional carriers, maybe in order to diversify their portfolios?
Do you want me to take that?
Yeah,
And
sure.
you can see,
You're a DUA.
Yeah. So here's how I would view this: is that yes, I think they like the portfolio view of it. So some of this business really might have never made it to the reinsurance market. So I do think they like the ex-cat portfolio management view, maybe dealing with an MGA that produces maybe 7 or 8 different programs, but gets the whole portfolio. So I do think there's going to be a move towards that as we go forward here. Again, they're going to stay away pretty much from cat, but I do think reinsurance do like the portfolio approach, and again, maybe selectively choosing some MGAs that might write a number of different programs. So not only do they diversify their risk even there.
All right.
Well, thanks for attending.
Thanks.
Yeah.